Figures 1 and 2 illustrate key conclusions from our paper. Figure 1 is showing what happened to the rate of growth of new housing over the last 50 years, basically. Figure 2 is the price counterpoint to that. So what did I learn from figure 1? One is something we already knew: the rate of growth of home building has gone down over time. That's why that line's sloped negatively for all those 6 markets that we follow in the paper. More interesting, I think, is how they converge over time. There are really big gaps between high housing supply markets in the 50s, 60s, and 70s versus low housing supply markets. But by the time you get to 1990, there's a much narrower gap. And when you get to the last decade, the 2010s, everybody's producing at roughly the same rates. So even though Miami, Phoenix, Atlanta, and Dallas have big population growth, they're not producing appreciably more housing than Los Angeles or Detroit are. That's going to have implications for what's happening to prices in figure 2. In figure 2, no surprise again that Los Angeles has the highest price growth over the last 50 years. But what is interesting is if you look since the turn of the century over the last couple of decades, the highest price growth is actually in the Sunbelt markets. Since the year 2000, Miami has appreciated at slightly greater rates than Los Angeles has, and Phoenix and Dallas are very close behind. So again, the link between those charts is falling and converging rates of home building over time with much higher price growth since the turn of the century in the Sunbelt markets that are still experiencing population growth.